On Thursday, February 23, 1995, Nick Leeson walked out of his office in Singapore and told a colleague that he had to visit his wife at the hospital. On his desk, he left a short note, "I'm sorry." Then he went to the airport and boarded a flight to Kuala Lumpur. Back in London, executives at Barings Bank were about to discover why he had disappeared. Hidden inside an account numbered 88888 was a financial hole so large that the bank could no longer survive it. Within 3 days, Barings was insolvent. This bank was founded in 1762. It had helped finance the Louisiana Purchase, survived wars, recessions, and more than 2 centuries of financial panic. It handled money for Britain's royal family and carried one of the most respected names in British finance. Then a 28-year-old trader destroyed it with losses of £827 million. And the whole disaster began with a much smaller loss that Nick Leeson believed he could fix before anyone noticed. Leeson joined Barings in London 1989, working in settlements. It was the less glamorous side of banking, checking trades, moving money and making sure the numbers recorded by traders matched what had actually happened. That experience taught him something valuable. He learned how traders were processed after they were made. He understood where mistakes appeared in the paperwork, who checked them, and which numbers were sent back to London. In 1992, Barings sent him to Singapore to help build its futures operation. Soon he was trading on the Singapore International Monetary Exchange. His official strategy was called arbitrage. Barings would buy a futures contract in one market and sell the same contract in another market where the price was slightly higher. The difference on each trade was tiny, but repeating it at high volume could produce steady profits with very little market risk. To the executives in London, the Singapore operation looked like a machine that produced money without making dangerous bets. Leeson quickly became its star. In 1993, his reported trading profit was around £10 million, roughly 10% of Barings' total profit for the year. At one point, management believed that his Singapore operation was generating more than 60% of the revenue from the bank's worldwide derivatives business. The more money he appeared to make, the more freedom he received. That freedom was built on a dangerous management decision. Leeson controlled the front office, where trades were placed, and the back office, where those trades were recorded and checked. In simple terms, he was allowed to place the bets and mark his own work afterward. The account that made the deception possible had already been created in July 1992. Its number was 88888, a sequence considered lucky in parts of Asia. It was supposed to hold trading errors made by inexperienced employees until those errors could be corrected. Leeson began using it to hide unauthorized trades and losses. When a trade failed, he moved the loss into 88888. The ordinary accounts still looked profitable, while the evidence of failure disappeared from the reports seen by London. He even persuaded a back-office programmer to change the reporting system so that transactions inside 88888 would stay out of the information sent to the headquarters. The loss kept existing. Barings simply stopped seeing it. By the end of September 1992, the account held losses of about 8.8 million Singapore dollars. Leeson responded by taking larger positions, hoping that one successful trade would recover the money and allow him to close the account. For a while, that approach sometimes worked. Whenever the market moved in his favor, he produced part of the hidden loss. Each recovery taught him the worst possible lesson. A large trading mistake could be repaired by taking an even larger risk. The next loss therefore felt temporary. He only needed more time and more money. By the end of 1993, the hidden loss had grown to roughly £23 million. By the end of 1994, it had passed £200 million. Barings believed it had just completed a profitable year. Its draft account showed a pre-tax profit of £102 million. In reality, the unreported loss in Singapore was already larger than that profit twice over. The money needed to keep the trades open had to come from somewhere. Futures positions require margin, meaning cash must be deposited with the exchange as security. As Leeson's position grew, Singapore demanded enormous transfers from London. Barings kept sending them. The margin requests did not match the supposedly low-risk client business that Leeson claimed to be running. Still, his managers accepted his explanations. His reported profits made the requests appear like the cost of supporting a highly successful operation. Success had become his protection. Barings even received a direct warning. An internal audit in August 1994 identified the danger of allowing Leeson to control both trading and settlement. The bank knew that one employee held two jobs that should have been separated. Management failed to correct it. In January 1995, an auditor found another discrepancy. Leeson created a story involving a transaction with an American investment firm and produced a doctored document to support it. That explanation bought him a little more time. By then, time was all he was trading for. Leeson had built enormous positions linked to Japanese market. He owned Nikkei futures that would gain value if Japanese stock rose. He had sold Japanese government bond futures, which required bond prices to fall. He had also sold options that were profitable only if Nikkei remained relatively stable. Then, in the early hours of January 17th, a massive earthquake struck the Japanese city of Kobe. Thousands of people were killed, buildings and highways collapsed, and the financial markets fell as investors tried to calculate the economic damage. Every major part of Leeson's strategy came under pressure. The Nikkei dropped, hurting his futures positions. Market volatility rose, hurting the options he had sold. Instead of reducing the risk, Leeson bought even more Nikkei futures. He was betting that the Japanese market would rebound quickly and strong recovery could finally erase the losses hidden inside 88888. The market continued to fall. As prices moved against him, the margin calls became larger. London kept transferring money to Singapore, unaware that it was financing a desperate attempt to recover losses that had been hidden for more than 2 years. During the final weeks, the numbers moved at extraordinary speed. 1/4 of Barings' eventual gross losses was created on a single trading day. On February 23rd, the Nikkei closed near another low. The hidden loss had reached around 1.4 billion Singapore dollars, and a settlement employee had found a discrepancy that Leeson could no longer explain. That evening, he left the office, wrote his apology, and fled. The next day, employees searching through the accounts found 88888. Barings finally saw the position it owned. The bank had recorded capital of roughly £350 million at the end of 1994. Leeson's losses reached £827 million by February 27. Closing the remaining positions pushed the total cost to around £927 million. The bank owed far more than it could absorb. Executives and officials spent the weekend trying to arrange a rescue. No buyer was willing to cover the unknown risks still buried inside the trades. On Sunday, February 26th, Barings was placed into administration. The institution had survived for 233 years. Its collapse took 1 weekend. Dutch financial group ING acquired the remains for £1 and injected hundreds of millions of pounds to support the business and its creditors. Employees lost jobs, shareholders lost their investment, and one of the oldest names in global banking disappeared as an independent institution. Leeson's escape lasted only a week. German authorities arrested him at Frankfurt Airport on March the 2nd. He was later extradited to Singapore, pleaded guilty to fraud and forgery, and received a sentence of 6.5 years in prison. Calling this the story of one rogue trader is accurate but incomplete. Leeson placed the trades, hid the losses, and falsified documents. Barings created the environment that allowed each action to continue. The bank gave one person control over both the money and the record. Managers saw profits that looked far too large for a supposedly low-risk strategy and treated them as evidence of talent. They sent huge amounts of cash to meet the margin calls without fully understanding why it was needed. An internal audit identified the central weakness months before the collapse, and the warning remained unresolved. Most importantly, every reported profit made the next question harder to ask. Investigating Leeson could interrupt the operation, producing much of the bank's derivatives revenue. Believing him kept the profits alive, protected bonuses, and allowed senior managers to think the system was working. So they kept believing him. The first hidden loss did not destroy Barings. It created a choice. Leeson could admit the mistake and damage his career, or conceal it and try to win the money back. Each time Barings funded another position without properly checking it, the bank made a similar choice. By the time the truth became unavoidable, the loss was larger than the institution built to absorb it. Barings spent 233 years building a reputation for judgment and trust. In Singapore, that reputation turned into complacency. Managers assumed that a respected bank must have reliable controls and that a trader producing millions must know what he was doing. The numbers were telling a different story. Nobody with enough authority wanted to read it.